Hi, a very good evening to ladies and gentlemen. Thank you for tuning in on time. I would just like to do a quick mic check to know if I'm being heard. Okay, so if you can hear me, maybe you can put in one in the question box so I can see that I'm being heard. Okay, can everybody hear me clear? All right, fantastic. Thank you for responding. Now I know I'm being heard. Okay, ladies and gentlemen, thank you for joining us here on our trading bootcamp today. Once again, my name is Jun Kit, and I'm from Phillip Nova. And today, this introductory bootcamp is actually an introduction, meant to prepare you for our trading challenge that will be beginning next Monday. Right, so this session is going to be jam-packed with a lot of information from the basics of the instrument that you'll be trading to a bit more advanced knowledge in terms of fundamental and technical analysis. And then you would also be guided through the trading platform that we'll be using for this trading challenge. And before we begin, just like to make a standard disclaimer here that whatever that we are sharing today is purely for educational purposes only and does not constitute as any financial advice because we believe that you should take responsibility of your own trades. And also today we are sharing all these things without the consideration of your own investment objectives, your risk appetite, and your financial situation. Okay, so this is meant to be an educational session to prepare you for this trading challenge that is about to come. Okay, the breakdown of today's session will be as such. We'll be sharing with you about this trading challenge, how it works, followed by introduction of FX and CFD, which is the instrument that you'll be trading, right? And after that, we are going to dive a bit deeper into the subject matter of technical analysis, which is an approach to study the market for shorter term trading, for example, like this trading challenge. Then we'll be going through a simple guide on how you can formulate your trading plan, as well as some risk management rules that you need to abide by for sustainably trading the markets for the long term. Okay, and at the end, we will be demonstrating to you the Phillip MetaTrader 5 platform that you will be using. Okay, just an introduction of the company. Phillip Nova, we were formerly known as Phillip Futures, and we've been in the industry for over 40 years, and we are actually part of the Phillip Capital Group. So you may not have heard of Phillip Nova as much because for the longest time of our existence, we were known as Phillip Futures, and our main clientele are futures traders. So therefore, it is a more sophisticated and rather a more experienced group of clients. So now we have expanded our offerings into different asset classes like FX, CFD, and if you want to buy a stock, buy an ETF for longer term investment, we also have them now. And therefore, to reflect our broader range of product offerings now, we have rebranded ourselves from Phillip Futures to Phillip Nova. And a little bit about myself. Once again, my name is Jun Kit, and within Phillip Nova, I take on the role as a strategist. And my main area of expertise is actually in Forex and CFDs. Okay, and I do participate and actively organize a lot of business development initiatives, such as an event like this, a trading challenge like this. And I do have the honor of regularly sharing my market views and commentaries on various prominent news publications like the Business Times, MoneyFM 89.3, Lianhe Zaobao, and most recently on Channel News Asia. All right, so the Phillip Nova Young Investors Trading Challenge 2025. And for those of you who, who may have heard of this trading challenge in the past year, you would know that this is not the first year that we are organizing this. In fact, I think this is the fourth or fifth year that we are organizing this annual trading challenge. Okay, so what is it actually? So this trading challenge, it provides novice traders, okay, with an opportunity to prove their skills. Okay, we're talking about novice traders aged between 18 and 30 years old. As the name suggests, that this is a young investors trading challenge. And then, the objective for this, I think at the end of the day, is for all of us to learn the craft of trading, and also for those young investors who are new to this field of trading to be exposed to this skill. Okay, and this year, 2025, we have managed to up the prices of the trading challenge. So the grand prize for this trading challenge for this year is actually going to be $2,000. Okay, and the second prize would be $1,000. Third prize, $500. And if you manage to rank on the fourth place all the way to a 10th place, you will still be entitled to a consolation prize of $100. Okay, so do bear in mind that this
Hey, JK,
the
sorry to
yes.
interrupt, JK. Can I just check if you are showing the slide with the prizes? I'm still on the first slide on my screen.
Oh, really?
Yeah, so you see whether it's loading fine on your end. If not, you might want to
Yes, I'm
reshare
sharing the
again.
one on the prizes.
Okay. Do you want to try resharing? Because I still see it on the first slide. Members of the audience, do you see? Uh, are you guys seeing the correct slide? Because I'm only seeing the first slide. Maybe just reshare. Yeah.
All right, how's it looking now?
Yeah, it looks good on my screen.
Okay. All right. Let me toggle. Um, okay, Sri, my colleague, thank you so much for jumping in. Because the interface that I'm using currently is not so easy for me to navigate to look at the questions currently. So just to confirm, are we showing the screen on the prizes currently?
Yeah.
Okay. And am I showing the slide on the event timeline?
I don't see that slide yet.
What about, are we seeing a new slide currently?
Not at the moment.
I see. Okay, ladies and gentlemen, we appreciate your patience while we sort out this technical difficulty.
Hey, JK, I just wanted you to know that I've shared the links that you wanted me to share on the chat box in case you want to give a overview on that.
All right. Currently, are you able to see the screen moving?
I see the prizes screen and the mechanics of the challenge, and now the price structure breakdown.
Okay, cool. Cool. Thank you. Thank you. That was a short intermission due to technical difficulty. Okay. Okay, so at the end of the sharing, I will take a look at the question box to address some of the questions that you guys are posting. Okay. So then let me move on. Okay, so today, as we see on this timeline here, we are at the introductory bootcamp phase where I'll be sharing about the essentials that you can learn about to prep you better for this trading challenge. And essentially, how this trading challenge works is that within a span of 10 trading days from next Monday until 30th of May, right, you guys will be competing in a demo environment, trading various instruments like FX, CFDs, and precious metals. And at the end of the 10th day, we will be looking at the equity balance of all your accounts. So the top 10 accounts with the top equity balances will be the winners. Okay, and do note that the start of the challenge next Monday will be at 5 a.m. SGT when the FX market opens, and the ending time of this challenge will be at 12 p.m. SGT on 30th of May. And on 5th June, very excitingly, we'll be having an award ceremony. So this will be held physically at our Raffles City Tower office. And this would also be a very fantastic opportunity for either the winners, the participants, you can attend yourself. You can also ask a few friends to join you for this networking session where we'll be inviting a professional trader to come and speak to all of us. Okay, just to share a bit about the price breakdown of this trading challenge. So the maximum entitlement is what you see on the final column there. So let's say if you're winning, you're the first person on this trading challenge, you're the champion, your guaranteed price is going to be 1,500 SGD. Okay, so there's a guaranteed portion and there's a bonus portion. If So just to talk about the guaranteed portion, upon winning it, okay, and upon successfully opening an account, you will be receiving this guaranteed portion of the trading credits. Okay, and if you would like to redeem or rather be entitled to the remaining of the bonus portion, you can do so by remaining active for 3 months. So the criteria are pretty simple. So for 3 months, from June to August, you only need to place at least 4 trades per month, and you cannot withdraw during these 3 months. Okay, so if you've met this simple criteria, then you will be able to unlock the full amount of the entitlement. Okay, if you like to read this deeper into the detail, you can look at the chat box where my colleague Sri has pasted the detailed terms and conditions for you to refer to. But long story short, this is the basic mechanics, right? And also, as the name suggests, we are doing a young investors training challenge, and therefore this is really aimed at providing younger traders with an opportunity. And therefore, to be eligible for the prizes, you need to be aged between 80 to 30 years old. Okay, and secondly, you must not have an existing account with Phillip Nova. So this is only offered to the traders who are new to Phillip Nova. Okay, and throughout the trading period, there is a minimum trading requirement of 5 trades using the trading challenge account that has been issued to you during this timing. Okay, and for those of you who have not yet signed up for the trading challenge yet, you can do so by scanning this QR code to register for the trading challenge. Otherwise, you can also go to the link in the chat box where you can click on it and register directly. Okay, and also, if you'd like to join our Telegram channel for the participants, you can scan this QR code and also refer to the link in the chat. So this is the Telegram channel exclusively for the participants, where we'll be sending in regular updates and reminders, and sometimes some polls to engage you and to make you feel, like you're part of this trading community, right? And I see one query where, okay, yes, I see that it's been responded already. Thank you, Sri. Okay, and also we do invite you to join us on our networking event on the 5th of June, because we speak to different young traders all the time, and I think one common struggle that we face is trading can sometimes be a very lonely journey. Like you yourself are into this crowd, but the friends around you, your family members are not into this. And I think a networking event like this is meant for you to make friends, to speak to like-minded, young traders, as a community of traders. We can all grow together and we can learn from each other. Okay, so that is an overview of the trading challenge that we are organizing this year. And if you'd like to find out more about this event, you can just go to the landing page. You can just Google, okay, Phillip Nova Young Investors Trading Challenge 2025. It will lead you to the landing page where we have the detailed FAQ, the detailed information, and all that in that landing page. Okay, so with that, completed, we will go on to talk about business, right? About FX and CFD trading. So the content that we shared today, because there's so many of you here tuning in, we don't know your experience level. So the earlier portion of it will be quite quite beginner friendly, to help everyone to get a basic understanding before we move on to some of the more advanced things like technical analysis and forming a trading plan towards the end. So first, I think it's very important to talk about trading. Okay, trading and investing, it is different. When you invest in something, you don't care what price you're buying it at. Okay, you just buy and hold it for long term. Okay, you're entering into a position either for capital appreciation or for dividend income. Trading, on the other hand, is different. It is more like an active way to participate in the market in order to extract a higher ROI as compared to the market return. All right. So what trading is, it is actually a systematic approach where you follow a structured plan with predefined rules in your trading. So it's supposed to be systematic. It involves consistent execution, whereby once you've established your trading strategy, you repeat the process with discipline, trade after trade. Trading is also about risk management because trading is all about managing your losses, to be honest, okay, and to protect your capital. Uh, you can only succeed in trading if you master the skill of risk management. And trading is also probability driven, whereby we focus on the long term success and not individual wins. Okay, we look at profitability in trading in a longer term sense. Okay, so we don't, the aim right here is not to go big on one single trade and hope that this single trade will be able to make us rich and retire forever. It is not like that. We control every trade, we manage our losses every trade, and in the longer term, the goal simply is to make more than you lose. Okay, losses are part of the trading game, and what we aim for is to make more than we lose. And trading is also edge based, whereby you need to have a trading strategy that has been proven and tested to give you profitability in the market. All right, so let's talk about what trading is not. Okay, so trading is not gambling, definitely. So let's say if you're placing trades today just on gut feelings or emotions or just guessing, that is not trading, that is merely gambling. And if you're trading without a clear cut criteria, or if you're chasing the market, if you're over leveraging, if your trading strategy switches from one to another within the day, or you keep changing strategies, that is also not trading. Okay, so this topic, it can get pretty deep, it can get pretty broad. But what I like to establish here at the beginning of this presentation is that in order to become a successful trader, you definitely need to put a homework to study about the instruments, to study about the market, and very importantly, to practice. Okay, and above all, you need to be able to protect your capital, to protect your market, to continue trading in the long term. There's no point in going all into trade and you end up losing all the money you have that you can trade on the market, and therefore you're out of the game. Okay, so to stay in the game is to master risk management. Okay, let's talk about the first asset class that we can trade during this trading challenge. It is Forex. And for those who are new, new to the world of trading, Forex, simply means a foreign exchange. It is a marketplace where it is a global decentralized marketplace where various national currencies are traded. Okay, and FX is actually just defined as giving of one currency for another at an agreed rate by both parties. Okay, it's just like textbook example stuff. So FX market is also actually the largest and the most liquid market in the world with 7.5 trillion daily traded volume. Okay, so it is not one of the largest, it is the absolute largest financial market in the world. Okay, and it operates 24 hours a day, 5 days a week, and Forex is also traded on a margin. That means whatever you're trading, it is leveraged, and you only need to outlay a small percentage of the entire contract value to begin trading. So FX and CFD, the two instruments that we are talking about today, they are considered over-the-counter instrument, whereby it operates differently than something that is exchange traded, like stocks and futures. These are the instruments where you have to go through a centralized exchange to meet buyers and sellers. Okay, so it all have to go through an exchange. For FX, there is no centralized exchange. It is all traded over the counter. Okay, so just think of it as like when you're going on, when you're going on holiday, and you like to exchange some SGD from, let's say, some Japanese yen. Okay, so you just go to a nearby money changer to just change your money, right? So that is what we call over the counter, whereby it is all done on a decentralized basis, and transactions and exchange can occur just everywhere in the world without an centralized exchange. So why is the forex market able to operate 24 hours, 5 days a week? It is because, like I mentioned earlier, it is over the counter. That means we don't rely on the opening hours on a certain exchange in order to exchange hands. So there are actually few forex trading sessions. Okay, so the first one is the Sydney session, which starts at 5 a.m. Singapore time. Okay, and somewhere in between at 8 a.m. the Tokyo market will open, and at 3 p.m. the London market will open, and at 8 p.m. the New York market will open. Okay, so different regions in the world, we take turn to open market and to operate, and therefore you'll be able to trade forex 24 by 5. Okay, so when the New York market closes, the Sydney market would come open, and you can begin trading again, or rather you can continue trading, right? And let's say if you're a trader who would like to trade when there is high volatility, when there are a lot of action, uh, the 8 p.m. till the 12 a.m. time period, it is the most active trading session, because this is the overlap between the London session and the New York session. Okay, two of the largest economic body, they are open at the same time. They are trading against each other. Therefore, there is a large flow of the liquidity that is being traded. Okay, and also during the overlap of these two sessions, it is when a lot of the high impact economic data are released, and therefore there is a great deal of market moving opportunities that traders could take advantage of. So what are some of the benefits of trading FX? First of all, it has very low barrier to entry. Okay, you can enter the market with a relatively small capital. Secondly, there is high volatility in the market, whereby traders trade because they think that prices are going to move. Okay, either it's going to move higher or it's going to move lower. What we want is for prices to move. Okay, there's no point in trading something where the prices don't even move, right? So FX, it gives you a lot of opportunity whereby the prices would move a lot, and therefore there's a higher chance for you to make money. And of course, with the chance of you making money, the downside risk is also proportional. So once again, risk management is very important. Leverage. Okay, you are able to open a larger position with a small amount of capital by trading forex, as it is all leveraged. Low transaction cost. FX is all traded at zero commission basis, and the spreads, which is the bid and the ask price, they are rather tight and low. So therefore, the transaction cost of trading forex is low. Bidirectional, that means you are able to go both long and short on a particular currency pair. Okay, so depending on your view. So whichever way the market is moving, as long as it is moving in a clear direction, you can look to take advantage of that directional trend by either going long or going short. Okay, so it's not like a traditional investing whereby you only would profit when the price of the stock that you buy appreciates. Okay, so for FX trading and for CFD trading as well, you are able to go both long and short. And lastly, FX market has very high liquidity. That means at any given point of time, you are able to enter and exit your positions without any significant price slippage, which simply means you can easily execute a trade at the price that you want to execute it at without much change in the price, or that is what we call the price slippage. Okay, so I always like to use this analogy whereby, when you want to play a game, right, you need to first know the characters, need to know the players in the game. And the currencies are the players in the FX trading game. Okay, and the eight of the most traded currencies, they are actually the US dollar, the euro, the Japanese yen, the pound, the Aussie, Swiss franc, Canadian dollar, and New Zealand dollar. Okay, so there's a total of 8 most traded currencies. And it's also very important to realize that currencies, they are never traded alone. They're never traded on its own. They are all traded in pairs. Okay, and generally there's three main category of the forex pairs. The first pair, or rather the first grouping, is called the major pairs, whereby it also includes a subset called commodity pairs. And what are they? We have the euro dollar, the dollar yen, the pound dollar, the dollar Swiss franc, Aussie dollar, US dollar, Canadian dollar, and lastly we have the Kiwi dollar. Right. So these are the major pairs where they are the most popularly traded currency pairs. And why are they called major? If you take a closer look, you'll be able to realize that the major pairs constitute of the US dollar. Okay, so that's first part of the equation. At the same time, it also constitute one of the 7 other most traded currencies. Okay, and next up we have the minus, aka crosses, whereby they are the mix and match of different currencies, the different popularly traded currencies without the US dollar. Okay, so out of these minor pairs, I think some of a pair like the pound yen, the GBP JPY is also a very popular cross pair that a lot of our clients or even traders out there they will trade because they tend to trend very nicely. And as traders, we always try to look for an asset where it is in a clear trend, it is in an easy trend for us to trade. Okay, we don't want to be trading something that is very choppy. Okay, it goes up and down, up and down, up and down within a tight range bound. That is not going to give us opportunity to profit. And next up, we have the exotic pairs, which are some of the, I would say, less popular trading pairs. And they mainly constitute of a currency from a smaller economy and an emerging market. Okay, so to put it simply, let's say if you're someone who's just trying to, start trading FX, you'll be looking at the majors due to its high liquidity and due to its narrow spreads, and there is always abundance of information and educational resources for you to refer to in your process of learning about how to analyze on these currency pairs. Because as beginners, we always try to make sense out of the market, and we always don't know why it is moving. And with these major pairs, there's always a lot of information out there written by professionals, written by analysts that you could learn in your early phase of trading. And with enough time of being in the market to read about all these, with time, you'll also be able to get a better sensing and better acumen of analyzing these currency pairs. And also, it has a high correlation with macroeconomic drivers. So we're talking about, let's say, if an interest rate, okay, if the US decides to increase its interest rates, and at times like this, the US dollar would have a high tendency to appreciate in value. Okay, so same goes to the inflation figures in the US. So let's say from today onwards, assuming the inflation figures in the US, they are coming down rapidly. Okay, so at times like this, the US Federal Reserve would be pressured, or rather they will be put in a position to cut rates. Okay, and with the reduction of the interest rates in the US dollar would also theoretically decrease. Okay, so by trading the major pairs, you are able to participate in such correlation of the currency value with the macroeconomic drivers. Okay, now let's talk about how do we read a currency pair. Okay, an FX pair is always quoted in a pair. Okay, like I mentioned, and the first 3 digits are normally in the base currency. This is what we call the base currency, and the second portion of the currency pair is what we call the quote currency. Okay, and when you are longing or when you're buying a currency pair, you are basically buying the base currency and selling the quote currency at the same time. Okay, so let's say if you long euro dollar, you are hoping for euro to appreciate against USD. Okay. On the other hand, if you are shorting the euro dollar, this is when you are hoping for the euro to depreciate against the US dollar. Okay, so is it up or down? You pay attention to the base currency. Okay, and just like going to the money changer, right? FX, just like going to the money changer, there's always going to be two columns of price that you look at. Okay, because the money changes, they would have two columns to look at, because there has got to be a difference between the buy and sell. Okay, and that is where basically the broker make money. Okay, so in that case, that is where the money changer make money. Do bear in mind that FX is traded on zero commission. So this is the only place that a broker like ourselves will be making our money. Just in case that you wonder, then if you don't charge me any commission, how are you making money? So this is where the forex brokers make money. Okay, and the good news is the difference between the ask and the bid, they are very tight these days. Okay, and therefore the cost that you are paying whenever you trade is actually very, very low. So let's say today, if you are buying a currency pair, okay, you'll be looking at the ask price, and when you are selling a currency pair, you'll be looking at the bid price. Okay, so on the MT5, as per this screenshot, it's very clear. The buy and the sell, you'll be able to know which price that you'll be selling it at. Okay, and in the forex world, if any one of you have dabbled into forex, you must have heard of this word pips. Okay, because FX, they don't move by cents. Let's say if a FX pair move by cents per day, that will be really crazy, and that is actually very drastic moves. Okay, so FX actually move in very small increment. Okay, and how we measure that increment is actually through the fourth decimal figure on the quote, which is what we call a pip. Okay, for the fourth decimal figure. Okay, and then to calculate the spread, which is the price, or rather the cost that you'll be incurring when you trade a currency pair, that is where you take the buy price minus the sell price, and there you have it. It's only 0.6 pips. Okay, so to put things into context, let's say if you're trading one standard lot of FX, so that is like 100,000 a notional value. Okay, and the cost that you'll be paying is only $6 for $100,000. Okay, so that's really just a tiny fraction of the total value that you are trading. Okay, and how this works is basically just assuming in a scenario where the prices does not move at all. Okay, the prices stays the same. You buy now and you sell now immediately. Okay, so off the bat, 0.6 pips, it is the cost that you would be paying when there's no price change. Okay, so essentially it is a cost that you'll be paying. Okay, and FX, like I said earlier, it is a leveraged contract whereby you only trade with a tiny portion of upfront margin. So in Singapore, to trade FX, there is a margin requirement of 5%. So to trade one standard lot of FX, which has a notional value of 100,000, the margin required is only $5,000. And a mini lot, which is 10,000 notional, the margin required is only 500. And to trade a micro lot, which starts from just $1,000, you only need $50 margin to begin trading. Okay, so this also debunks the myth where some people think, oh, you need a lot of money to begin trading Forex. No, you can start participating in the Forex market with a micro lot with a margin of just $50. Trading with a margin, it does give you the leverage effect, that allows you to use a small amount of capital to make an investment of a much larger value. So therefore, a small price change can result in large profit or losses. Okay, so it magnifies the potential profit, and at the same time, it also magnifies your potential losses. So it is very important to be aware that this is a double-edged sword, and risk management is very, very important when it comes to leverage trading. And I will be going through that portion later in today's presentation. Okay, so with that, I have completed the sharing on Forex. Okay, so essentially it is the trading of one currency against another, and it is influenced by various macroeconomic factors. Either it's a country's economic growth, a country's inflation, interest rates, etc., etc. Okay, so basically you'll be speculating on the value of the currency when you trade FX. Now, what I'm going to share with you is a different instrument. Okay, it's what we call a contract for difference. So, what is a CFD? CFD is actually a derivative whereby this is an instrument where the price is derived from an underlying asset. Okay, so the underlying asset can be things like stocks, ETFs, commodities, and indices, etc. Okay, and some of the more well-known derivatives are things like futures and options and forwards. So these are the things that you may have heard of. So CFD and futures and options, they belong in the same category, whereby they are derivative and their value is actually derived from an underlying asset. So when you are trading CFD, you are not actually buying anything. You are merely entering into a contract to settle the difference in the value of the underlying. Okay, so essentially, it is an agreement between two parties to settle the difference between the opening and the closing price of the contract. So in this instance, it is a contract between the client and a brokerage house like Phillip Nova. And through this process of trading, there is actually no physical delivery of the underlying. So let's say if you're trading a crude oil CFD, okay, you're entering into a contract merely to speculate on the price, to exchange the difference of your exit price with your entry price to try to benefit from that price change. And in this process, you're not you're not buying into any of the physical underlying asset, and there will be no physical delivery of that underlying asset. Okay, and CFD, it is as like what I mentioned earlier, the price is derived from the underlying asset. So let's say when you're trading US share CFD, okay, you can only trade it when the underlying market is open, and when the market is not open, you simply just cannot trade it because there is no price for the CFD to derive the prices from. Okay, and one key feature of CFD, unlike futures, is that it has no expiry date. Okay, if you trade futures, you have to be aware of things like the expiry date, and you need to be aware of when to roll over, those kind of things. With CFD, you can open a trade today and you can hold it for as long as you want. There is no need for you to roll over your contract. So some of the assets under CFD that you can trade are things like global indices, shares, ETFs, energy, commodities, and more. So just to share some of the examples that you are able to trade during this trading challenge, global indices. So let's say if you want to take a view on like maybe Dow Jones or Nasdaq, S&P 500, or even the Asian indices like Hang Seng, or even Nikkei 225, you are able to trade that. And if you are into equities, you can also trade a wide range of shares CFD on Phillip MetaTrader 5. So we have shares from SGX, from Hong Kong Exchange, from NYC, Nasdaq, and also shares from the DAX, which is the German Stock Exchange. Okay, and also there's a wide array of ETF that you can trade during this trading challenge, and also some of the commodity CFD that you can trade, like the WTI crude oil, Brent crude oil, and if you're more into commodities, you can also trade things like coffee and cotton as well. Okay, so right now I'm going to share with you how do you actually calculate the profit and loss of CFD. Because let's say if you're trading futures or options, right, there are things like strike price, exercise price, different kind of things for you to be for you to take note to calculate the P&L. And for CFD, it is rather straightforward. So let's say we take a long trade as an example. You enter into a CFD contract with an entry price of $900, and after that you exit the trade at $930, and at this time you actually trade 10 shares. Okay, to calculate the P&L, you only need to take the exit price minus your entry price times 10, and that is going to be a profit. As simple as that. If you look at a short trade example, if you enter into a short trade at $900, and after that the price did dip, okay, and it goes down to as low as $860, and if you trade 10 shares of in this trade, how you calculate your P&L is basically you take $900 minus 860 times 10, and you'll be able to calculate your profit, which is $400. Okay, so of course we have to be in mind that let's say if you're entering the long trade, if the prices actually dips below your entry price, your P&L will be negative. Okay, that means that you'll be losing money. And let's say if you're going on a short trade, if the exit price ends up higher than your entry price, this is also a time where you'll be making loss. Okay, and once again, I have to stress that risk management is very important when it comes to FX trading or CFD trading. Similar to FX, CFD is traded on a margin, whereby you don't need the full amount of capital to trade the full position. So let's say we have like Brent crude oil, the margin requirement is only 20%. For shares and indices, the margin requirement would range from 5 to 20%. So let's say, for example, if you want to trade the Nasdaq, with $100, you can already start gaining exposure in the Nasdaq index's movement, with just 5% margin. So CFD, similar to FX, it is also traded on a zero commission basis. And at the same time, there is no platform fee, there is no exchange fee. The only fee that you'll be incurring would be the spread and the swap. Okay, so the spread I've covered earlier, and let's look at what is a swap. A swap is only incurred when you carry a position overnight to the next trading day. So the swap portion actually consists of financing cost, it consists of interest rates differential, it consists of cost of carry adjustments, it also includes things like corporate actions if you're trading share CFD. Okay, so this may look like a lot to digest, but think of it this way. You are trading leveraged. That means I'm only putting up 5% of the contract value to trade 100% of the contract value. And where does the 95% of the contract value come from? You actually borrow them to trade. Okay, so to put it bluntly, to trade leveraged is to borrow money to trade. And whenever you borrow money, you do need to incur a financing cost. Okay, and swap is essentially largely just the financing cost in your trade. And also, because this is a zero commission kind of trading instrument, right? So it is very suitable for traders who want to trade actively. Okay, they are looking to enter into trade and exit within a day or within a few days or a few weeks, and therefore with this frequent trading, the commission will not eat into their profits. At the same time, as differing from the traditional kind of investing where you enter into a long-term investment, you pay commission once, you hold it forever. CFD, while it doesn't charge commission, you do have to note that the swap portion, which is the financing portion, this it would accumulate with time. Okay, so let's say if you're looking to get into a long-term position, it is better to invest into a stock right? Actually buying the stock rather than entering into a CFD contract, because if you hold the position for a long time, the swap portion would accumulate and end up it may have the possibility to eat into your profit as well. Okay, so do note that CFD is an instrument more for shorter term trading. And how do you calculate the swap portion? You can actually go to the trading platform and you can launch up the specification, okay, which I think I will demonstrate to you later on. Or maybe you can take a screenshot of this screen to remind yourself how to calculate the swap points, just for your notation. And basically, you are taking the tick value in the trading platform times the swap long if you're going a long position, and times the quantity that you're trading. And with this, you can calculate the actual amount that you're paying. Okay. But I think for this trading challenge, I think this isn't going to be much of a concern. It is more of like for your knowledge, if you're looking to actually trade CFD in your live account after this trading challenge. And a few benefits of CFD trading is actually, first of all, the barrier to entry is very small. If you're trading shares, normally you have to trade in terms of like a bot lot, minimum of 100 shares to trade. For CFD, you can start trading from as low as just one share. And for indices, right, because indices are so large, and normally, with some other instruments, you only can trade like in a bot lot of maybe 5, index of 1. With CFD on our platform, you can begin trading these bigger indices from zero point 0.1 lot. Okay, so with zero point 0.1 lot plus the 5% margin, the margin requirement to begin trading these big contracts is actually very low. And secondly, is that you are able to trade in both bull and bear markets. If you think the market is going to go up, okay, you can long. If you think the market is going to go down, you can go short on it. So either way, you are able to participate. Okay, so I do read a comment. Is there swap price for Forex? Yes, there is also swap for Forex, and I can demonstrate to you later on the platform how do you look at that. Okay, and CFD, there's no expiry date. You can hold on position as long as you want, but do note that the swap would accumulate with time. So it's good to be aware, or rather know what kind of strategy you are trading. And CFD is more for shorter term trading. Low trading costs, capital efficiency are some of the things that I've mentioned. So the last portion here, hedge position. Okay, we're talking about real life scenario here. I think for most of us, we may have some long-term investment positions in some stocks or some ETFs, right? So where CFD can come in is in a scenario whereby your investment, like let's say you're buying into Tesla stock. In the long term, in 5 to 10 years time, you think that Tesla is going to go to the moon, it's going to increase in value by manyfold. Okay, long-term bullish. But in the short term, there are some adverse news that is causing the price to dip. Okay, so let's say if you foresee the price to continue dipping for the next few months, so this time you actually don't have to sell off your long-term position. You can just hold it for the long-term appreciation. Okay, and at the same time, you can go short on your investments with CFD. Okay, so it's more like, let's say if your long-term position is losing money, right? Then you can go short on this stock, and then you'll be making money out of falling prices without touching your long-term investment portfolio. Okay, so I've managed to cover the basics of FX and CFD as an instrument. Okay, I think next up I will be sharing with you some of the basics of fundamental and technical analysis. Right. So I think for those of you who may have started trading a little bit, or who are looking to try to make money off the market, I think this portion onwards it will be really interesting. Okay, and I urge that we take notes when you think that some of this information are available to you. So whenever you trade, there has to be some form of analysis. There has to be some form of basis to support your trading decision. Okay, so it cannot be just through gut feeling. You think it's going to go up, then you buy. You think it's going to go down, then you sell. You need to have some form of analysis and basis of decision. So there are two main train of thought. The first one is fundamental analysis, and secondly, it is technical analysis. So fundamental analysis, we are actually looking at the actual events that are impacting the value of an asset. Okay, so this kind of real world event, they could if affect the supply and demand of a certain asset. Therefore, it would cause the value of a certain asset to either go up or go down. So let's say if you're analyzing the market through interest rates, through inflation, through central banks policy, or even let's say if you're looking to invest in stocks and you analyze that financial report, that future potential growth, all these are considered fundamental analysis, whereby you're actually looking at actual reasons, actual factors that are affecting the price. And one very effective tool for the fundamental traders to gauge, or rather to look at the real world economic events in order to trade, is by looking at the economic calendar. Right. So what is an economic calendar? It is a calendar which lists up all the key economic events that are upcoming. Okay, and it would include things like interest rates, inflation reports, non-farm payroll. All these are very important economic data that would affect the market. Okay, and different events, they would have the different impact of the market. So some events, they can be releasing the data, but it wouldn't affect the market that much. And some event, like let's say the interest rate decision, the GDP data, these are the high impact event that will move prices. And with an economic calendar, you can keep track of all these that are happening. You can also gauge the impact of these events. So based on my screenshot here, if you see the bar is full red, right, then you know that this is a very important data that is going to have a huge impact on prices. Okay, and they will also tell you what is the previous data, what is the consensus data, and what will be the actual data when it releases. Okay, so how people read it is normally that they'll be comparing the actual figure versus the consensus figure. So basically, let's say if you're looking at US dollar, right? If the US inflation figure, okay, it comes out to be higher than what the market expects. Okay, so this is a positive surprise, and therefore the US dollar would also react by increasing. Okay, theoretically. In the alternate scenario where the inflation figure comes out to be weaker than what the market thinks it is, then at this time the US dollar would also depreciate in its value. But of course, I think this is very much theoretical. But when it comes to actually trading the market, right, it is always good to stay away from such economic events when they release, because at times of release, basically you wouldn't know if the data is going to outperform or underperform, and the market could behave very unpredictably. So in short, there's no way to predict the outcome of the data, and when you are placing a trade before that, you are merely just hoping that the data is going to move in your favor. And also at times like this, the prices tend to whipsaw. That means it will go up very sharply and come down very sharply. It is likely going to take your stop loss and maybe move in the direction that you originally think that it's going to move. Okay, so it is always advisable, I think, to stay away from economic events when you're trading, because it is very risky. Okay, next up, we can talk about technical analysis. So fundamental analysis and technical analysis, they are very different things. Technical analysis, what we look at is purely the price action. We look at how the price has behaved, and from there we study the mood of the market, and with that we place our trades according to what we see in the market. If the market is telling us that there is more of a bullish momentum, we will then place our trades against, or rather place our trades with the generic trend, that is to go long. If through technical analysis we see that the prices is on a downtrend, we would then place our trades with the downtrend by going short. And essentially, with technical analysis, right, what we hope to achieve is really to be able to identify the start of a trend early. Okay, once we have identified this, we want to enter into a trade at the early stages of the trend. Okay, and the third part is that we want to be able to see that the signs of the trend is reversing, and at this time we would choose to exit the trade. Okay, and the best time to trade is actually when the market is trending, because if the market doesn't move, if the market goes all choppy, it goes up down within a tight range bound, really the chances of you having your stop loss hit out, is just really high. And generally we would only want to enter into a trade if we see that the market has been trending nicely, okay, and it is likely to continue trending, then we trade. You may have heard of the saying that goes like, the trend is your friend. I think that is very true. When there is a trend, there are opportunities for people to trade and to make money out of it. So technical analysis, you may have, assuming that you have gone online to learn different technical analysis concepts, okay, and what we realize, a lot of our clients or even a lot of the beginners out there, they learn TA in a very fragmented pattern. Okay, they learn about support and resistance, they learn about Japanese candlesticks, they learn about technical indicators. It's just all over the place. Okay, and through my next few slides, I hope to consolidate them and try to convey to you that you should look at technical analysis as a picture. Okay, all of these are dots, and the dots should be connected. And when you are able to connect the dots between different TA concepts, okay, that is when TA is really able to provide you with some useful insights in your trades. So there are mainly two schools of TA techniques. So there is the Western side of the TA, which of course they are developed and popularized by the US and the Europe side of traders. So these concepts are things like support and resistance, chart patterns, technical indicators, and also volume analysis. Okay, and on the Japanese TA side of things, there are things like Japanese candlesticks, which, like the name suggests, it is invented by the Japanese. And these two, the Western and the Japanese, they are separate. They are different concepts, but they should be used together to derive some useful trading signals for you. Okay, so in the next few slides, I will guide you guys through a journey of how to identify a trend. Okay, so there are a few objective ways that we could adopt to identify trend. One of it is to draw trend lines. So by going the textbook example of identify a trend line, okay, so let's say if doing an uptrend, if you are able to connect 3 consecutive dots to form a straight line, that is when you have identified an uptrend. Okay, and if you connect this high lows, high lows, high lows, and this line would actually serve as your support line, right? In a downtrend, if you are able to connect 3 lower highs, then that is deemed to be a downtrend. And whenever you see, so the first high, second lower high, the third lower high, once you're able to connect these 3 highs, okay, this would be a resistance line already. And the moment that the prices rises to test this line for the 4th time, you know that there is a high chance that the prices is going to meet a resistance here and bounce back lower. Okay, so in this example, we see very clearly that the 4th, 5th, and the 6th time, the prices did touch this resistance line and it did bounce back lower. And also, there is a sideways trend where the market is pretty much just consolidating in a tight range. And if you're able to connect the parallel horizontal lines, and this is where you identify a sideways trend. And as a trader, when I see a trend like this, it just tells me that, okay, there's nothing to look here. I would wait for it to break out and to form a clear trend before I consider entering the market again. Okay, support and resistance lines. So these, resistance lines, okay, we can talk about resistance lines first. They are actually something like an imaginary ceiling where the prices just cannot go above. Okay, so whenever the prices hit this level, people will start to come in and sell. Okay, so whenever the prices come in, people sell. Price rise up again, people sell. It forms an imaginary ceiling that prices just couldn't penetrate above. Okay, on the opposite side, a support level is just a price level whereby whenever the prices drops to this level, the buying interest would arise and people would come in to buy, and prices would then be pushed up higher from this support line. Okay, so let's take an example. Bitcoin. 100K is used to be a prominent resistance line that whenever prices hit 100K, I think for sometime last week, then it bounced back down again. Okay, when prices hit 100K, it bounced back down again. So that is a imaginary ceiling that traders think whenever it's here, people are going to start selling, and therefore they start selling as well. Okay, what happens when the price of Bitcoin reaches above 100K? Okay, so if you realize in the past few days, prices has been staying above 100K. So now this 100K level has become an imaginary support floor that keeps the price elevated above 100K. Okay, so this kind of support and resistance line, it can be drawn horizontally, like the Bitcoin scenario, and at the same time, or rather in a different scenario, it can also be drawn uh, like dynamically, like diagonally, like my previous examples. Okay, then during my previous slides, you may wonder, the charts don't always look so perfect. You can't always connect a few higher highs and lower highs to form that perfect line. That is true. The market are often not so, clear cut. And at times like this, we can make use of some technical indicators to help us objectively look at the trend of the prices. So one very important tool, one very useful tool is a moving average whereby it is a line that smoothens out the prices of the on the chart. Okay, so basically it helps you determine the trend with much less noise. Okay, so there are two types of moving average. The first is the simple moving average. The second is the exponential moving average. But I'm not going to go too deep into detail on what they are. But what I'm going to say is just that the EMA, the exponential moving average, is a more useful tool out of the two because it gives you a more responsive signal. It reflects more of the latest price action. Okay, and this is an example of the most popular EMA lines that the traders would use. Okay, the standard periods that all people always use are like 20 EMA, 50 EMA, 100 EMA, and 200 EMA. So what do they mean? 20 EMA, this line, it smoothens out the price movements of the past 20 days. Okay, it smoothens the price of the past 20 days. And taking the example of the 200 EMA, it smoothens the price movement of the past 200. Okay, so you see, the longer the period of the EMA, the smoother the line it is because it just filters away all the short-term noises and show you generally if the price is going up or going down. Okay, generally when the EMA is sloping upwards, it tells you that it's in a bullish uptrend, and when it's sloping downwards, it is telling you that it is on a downtrend. Okay. I see a question that you are not hearing me. Can I confirm that I'm being heard, Sri?
Yeah, I hear you loud and clear.
Okay, okay, okay. Just to address this very important question. Okay, so the rest of the questions I see you, but I'll come back and address them later in the presentation. Okay, so we're speaking about identifying the trend, right? So whenever the trend is in an uptrend, generally the prices would tend to stay above the moving average. And whenever the prices is below the EMA, it tends to tell you that the prices is in a downtrend. Okay, so simple. When price is above the EMA, it signals uptrend. When prices is below the EMA, it tells you that it is in a downtrend. Objective way of looking at the market to tell you if it's on an uptrend or a downtrend. Second way of using the EMA is by paying attention to the crossover. So in the first bubble that I've drawn here, whenever the shorter EMA crosses below the longer term EMA, this is what we call a bearish crossover. Okay, whenever it crosses, it signals that the tides have turned and the trend is changing. Okay, TA, what we hope to do is to be able to identify when a new trend is about to start, and a bearish crossover like this is exactly the kind of signal that tells you, okay, a new trend is about to start. Okay, and also on the other scenario whereby the shorter term EMA crosses above the longer term EMA, that is what we call the bullish crossover, which means that it gives you a high chance that the prices is going to change from a bearish trend to a bullish trend. It is important to share with you that while what I shared in these two slides, they look very simple, they look very straightforward, EMA tools are only useful when the market is trending. Okay, when the market is clearly trending. Because just imagine if the market is trading in a very tight range bound, it is consolidating, it is very choppy, it goes up, down, up, down, up, down. At times like this, the EMAs are going to keep on crossing each other, keep on crossing each other. And if you take every signal that the EMA crossover gives during a consolidation period, it's going to give you a lot of false signals, and it's going to be very detrimental to your trading account. So it's important to only use signals from the EMA when the market is trending very nicely. And if you notice, in a clearly trending market, these EMA lines, they tend to serve as a support or resistance line. Okay, so whenever the price is in a downtrend, if it goes down, if it tries to retrace, to rebound a little bit, when it hits its EMA, it's going to come back down again. So this EMA, they would also serve as some potential entry and exit points for you to place your trades with. Okay, another tool that traders can use to identify the trend is to use a tool like the Relative Strength Index, RSI. Okay, RSI, it is a momentum oscillator where people normally look at two key levels. Okay, they look at the 30 level, which is what they call the oversold level. Okay, and the 70 level, which is the overbought level. So to put it simply, based on this indicator, right, when prices dips below 30, it gives a buy signal. When it rises above 70, it gives you a sell signal. Okay, so as we can see from here, the few times that are highlighted here, prices did bounce up after it hits 30, and prices retrace after it hits 70, and prices rebound again after it touched the 30 level. Okay, so that's the way number one that you can use RSI. The second method that you can use RSI is by looking at where the RSI is in relative to the middle point, which is the 50 level. In an uptrend, generally the RSI would be above the 50 mark. And in a downtrend, the RSI would tend to be below the 50 mark. And the third use case, which I think is the more useful use case on how to use RSI, is by looking at the divergence between the price and the RSI. Okay, so from here, what I'm showing you is you are able to see that the prices, they are creating higher highs. Okay, during this time, the prices are creating higher highs, and at the same time, the RSI is creating lower highs. So at times like this is what we call a bearish divergence, where the momentum oscillator is telling you that the momentum of this uptrend is coming down. Okay, the buyers are losing steam. The buyers are not as strong as they used to be, and therefore at this time it gives off a signal that there's a potential reversal in prices. Okay, very important use case of RSI in my opinion. If I think, and I think this is like the most useful use case of RSI. Okay, so we have the bearish divergence. The opposite also applies when the prices create lower lows, and at the same time, if the RSI create higher lows, this is what we call a bullish divergence, and it will signal to you that the prices may reverse to the upside from here. Okay, and also in this example, you can see that besides this RSI drawings that I did, the EMA also did crossover. So if you manage to spot this RSI bullish divergence, okay, like as it happens, and when prices did go up, and when the when the EMA display to you a bullish crossover, this is when you can look to consider an uptrend. Okay, so you see prices went up right here, it come back down, it touches this blue color, this purple EMA. Okay, this is the point where, like I said earlier, in a clear uptrend, this EMA, they tend to serve as a support line, and this is actually a potential entry point for you. You see how prices did go up, okay, it come down, and it did touch this EMA line again. Okay, so once again, this showing to you that the EMA lines, they serve as very important level that, what my suggestion for you is that you can always have EMAs launched onto your chart in your trading platform, because I think it is just a super useful way for you to, gauge the market and to provide you with like potential areas where you can enter into the market. Okay, so RSI, okay, is it the most useful tool? I think the answer is no. I don't think it is the most useful tool. I think it is only useful when the market is in a range bound, in a range bound, kind of situation. Because let's say if a market is on a clear uptrend, okay, when the market is on a clear uptrend, what is the RSI going to tell you? Okay, the RSI is keep going to tell you that, oh, it's overbought, overbought. RSI will keep on staying above 70, and therefore if you sell every time the RSI hits 70, you're going to end up with a lot of losing trades. Okay, so in a market where it is clearly trending either up or down, use EMAs, don't use RSI. And let's say if a market is in a broader tight range, this is when you can consider to use the RSI. Okay, so I've demonstrated to you in the previous few slides on how you can, identify the generic trend, okay, by drawing lines, launching of, EMAs on your chart. And at this time, what you want to do is you want to look for chart patterns, whereby we want to enter at moment where, when the prices is consolidating after it break up. Okay, I know this may sound a bit abstract. Okay, so what I'm sharing with you on this screen are continuation patterns. Okay, whereby prices after they move up in a strong, in a strong momentum, it consolidates. Okay, it remains a tight range bound for a short period of time to consolidate and to gather steam before it continues its next leg of the move. Because prices never move in a straight line. And what we hope to capture as a trader is, firstly, okay, price is in a clear uptrend. Okay, but we know that the price would never move in a straight line. It will always rise, coming down, retrace, consolidate, and it will continue again. So what as a trader we want to do is we want to be able to identify moments like this when the price is consolidating within a clear uptrend. And when it breaks out from a consolidation pattern, like what I'm showing on my screen right now, this is when you can consider to enter into the trade according to the prevailing trend. Okay, so these are some of the examples that I think are very useful. I'm not able to show to you all the chart patterns that are helpful, but you can on your own time search up about different triangle patterns. So these are things like a bullish, a symmetrical triangle, ascending triangle, and descending triangle. So these are all very useful patterns to use them as continuation entry model to trade. Okay, next up, I will share briefly about candlesticks. Okay, so candlesticks, how to read it very simply, it consists of a body and upper and the lower wick. So how do you read a bullish candlestick? Okay, so from a bullish candlestick, the bottom of the body, it is actually the opening price, and the top of the wick is the high price, the bottom of the wick is a low price, and at the top of the body, this is the closing price. Okay, so assuming that you're looking at a daily chart of euro dollar, okay, so on a daily chart, one candlestick, it represents the movement of one day. So with one candlestick, you are able to tell that within this day, it opened at this point. Throughout the day, it rose up as high as that point, and during the day, it rose as low as this point, and ultimately, it closed at the high point right here. Okay, so the same principle applies to the bearish candlestick. Prices opened up here. You see the high is there, the low is here, and end up it closed at the point that is lower than opening price, and therefore price did come down, and this is why we call it a bearish candlestick. And there are many candlestick patterns that you could learn online and all that, but I'm just here to give you a basic principle on a basic logic on how to read candlesticks. So generally, the longer the body, rather the bigger the body, the fuller the body, the stronger the momentum is. Okay, and generally, the narrower the body, the weaker the momentum is. Okay, and at times when you start to observe that the candlestick patterns, they are exhibiting like a very narrow body, this is a time where either the prices is consolidating, okay, it's not going anywhere, it's just consolidating, or this could also be an area where prices could potentially reverse from the original trend. Okay, so some of the more popular, more common short body candles pattern are like doji candlesticks. There's also things like the hammer and the shooting star. You can take your own time to read up about what these mean, but because there's just too many. So what I'm trying to say here is that generally the bigger the body, the stronger the momentum in that particular direction. Okay, so we've talked about how to read the trends, and I've also shared about how to understand the candlesticks. And what I realized is in recent years, I think there are a lot of online trading guru, FX trading guru. They are teaching a lot of all the candlestick patterns that that has caused a lot of traders, when they read the market, they are looking at very macro. They are looking at just the candlesticks, how they move, and that would guide their trading decisions. But what I like to impose upon you is that we should always look at the bigger picture, whereby we shouldn't just focus on the candlestick patterns, because I think these are very macro, very very macro signals within a broader picture. Okay, a good approach to look at a market is by always looking at the daily chart. Okay, you identify the trend with the EMAs, the trend lines. Okay, and then when it comes to actually executing a position, you can then look at the candlestick patterns to look for it's either a very specific entry or exit signals. Okay, so this is an example where we try to seek signals between different TA concepts to give you a trading call. Okay, so assuming you identify a key support level using a Western TA, whereby the prices is above or is touching near the 200-day EMA. Okay, so prices above EMA, bullish. Secondly, you are seeing a bullish hammer candlestick pattern. Third, you see that the RSI is around 30. So all these signals, it tells you that the price is near a support level. The RSI tells you that it's going to bounce higher, and the candle is telling you that the bulls are rejecting the lower prices. Okay, so with a combination of these different signals, it gives you a strong buy signal. And here's an example. Okay, so you see how prices, they consolidate. Okay, it rise, it starts to consolidate. Okay, forming this ascending triangle pattern, and at the same time, prices is also finding support above the 20 EMA. And thirdly, you see that you are starting to see the longer wicks in the candlestick patterns. You are starting to see a lot of hammer, a lot of doji. So this is the kind of signal where it tells you prices is finding support above this horizontal zone. And upon the breakout of this ascending triangle pattern, as shown by this bullish candle, bullish green candle, it gives you a buy signal that is a pretty solid one. Okay, so I think due to the interest of time, I realized I've got too much information to share, because honestly, like, trading is it's a very wide topic with a lot of different nuances, and people will often take years to master. And today, what I hope to share with you is really the brief overview of the key pillars in trading. And after this, we really encourage you to take your own time to master this craft, to study deeply into the different subject matters, and therefore to benefit you in your own trading. Okay, so right here I'm gonna guide you through a simple way of crafting your own strategy. This is all in line with what I've shared in the earlier slides, whereby we try to identify the trend and we try to follow the trend. Okay, step one, you see where the price is in relative to the EMA. Okay, and secondly, you look for area of consolidation, of correction. So at times like this, continuation pattern would tend to form, things like ascending triangle, descending triangle, symmetrical triangle. These patterns would tend to form after a strong move in a certain direction. Okay, and then at this point, we want to evaluate, is the risk reward sound. Okay, so as an example, when people trade symmetrical triangle, okay, how do people trade it? First of all, you need to be able to identify the pattern. Okay, you've managed to connect at least 5 points, 1, 2, 3, 4, 5, and 6. Okay, so this is a symmetrical triangle. And the top part is the resistance line, whereby if it breaks above the resistance line, it is what we call a breakout of this structure. And how do you measure, or how do you determine the target level for this kind of trade setup? You take the height of the previous bullish move. Okay, you take the height and you plot it on top of the symmetrical triangle, and there you have it. The upside target is then derived. Okay, and in terms of the downside risk, at what point do you cut loss? At what point do you acknowledge that this setup is not what I was looking for in the first place? It is going to be below this. Is going to be below the support line and below the swing low right here. Okay, so with this trade setup, the risk reward ratio is about 1 to 4.6. That means I'm only risking this portion, okay, part one part, and with a potential of getting 4.6 part of the reward. Okay, so it's a sound risk reward ratio. So on the right side, what you're seeing here is a formation that has failed. Okay, and if it broke out from the support line or from the upper resistance line and it reversed down again, this is when we cut our losses quick and we just realize our loss. We don't hold on to a position, we don't hold on to a losing position in hope that it would reverse against our favor, reverse to our favor. Okay, so basically you cut your loss quick. Okay, so then after you've identified this trade setup, okay, so assuming all good, you want to enter a trade, this is when you need to know how much of a lot size that you're actually trading. Okay, so it's very important to always set a stop loss level, and also you can make use of different kind of market orders like buy stop, buy limit. So these are the order types where you input, and then when the prices hit a certain level that you want to hit, it will hit it for you. So assuming that you are looking to enter into a buy order at a certain resistance level, but you don't have all day to look at a chart to execute when the price actually hit that level, right? So at this time, you would want to set an order, like a buy limit order, whereby when the market price hits this level, it will automatically execute the order for you. Okay, automatic. And after the trade is done, what you have to do is that you have to monitor the position. So assuming that the prices have moved with your direction for, maybe like a certain percentage above your entry level, this is when you can consider to move your stop loss to your entry price. Okay, this is what we call moving your stop to break even. Okay, so this is to protect yourself in case the prices reverses against you. At least it wouldn't reverse past your entry point and hit your stop loss level. It would exit the position for you at the break even price. Okay, so the moment you move your stop loss to the entry price, this trade is effectively a risk-free trade. Okay, so a few risk management tips that you can abide by is always set a stop loss, and for every trade, never risk more than 1 to 2% of a portfolio. Thirdly, you calculate your lot size. Okay, so to do this, you can download a lot of third-party lot size calculator, whereby you input your entry, your stop loss, your account size, your percentage that you want to risk, and it will automatically calculate for you what is the optimal lot size to trade. Okay, and fourth, you should always only enter a trade when it is giving you a risk reward ratio of at least 1 to 2, because it doesn't make sense if, let's say, you are risking $100 to make $50. It just doesn't make sense. All right, so for every $100 that we are risking, we want to make at least $200 and above. Okay, so at this moment, I think we can move on to demonstrate to you the trading platform. Okay, yes, we actually set out for the session to end at 8 p.m., but I realized I got a bit too much to share. In fact, what I'm sharing about trading is really just the tip of the iceberg. I wish I have more time to go more in depth into each of these points that I talk about. But no worry, we all start somewhere, and we do regularly have a lot of seminars, or webinars that talk about different specific topic about trading. So we welcome you guys to join us, in our future events where we can drill deep into each of these topics. But for today, we are really trying to just give you an overview of how the thought process should be when it comes to trading, and you're encouraged to focus and learn more about these individual topics on your own. Okay, and yes, you will be receiving the recording from this session. Okay, so this is the Phillip MetaTrader 5 platform that you will be using to participate in the trading challenge. Okay, and upon registering for the demo account, if you don't find your welcome email, if you don't find your login credentials in your main inbox, you can go to your junk mail, because at times it would tend to land there. Okay, so after you manage to find that email, you can have the link to download the tool. You can have the link to download the platform, and also your login credentials will be in that email as well. Okay, so after you're in, how you log in? Very simply, you go to File, you go to Open Account, you search Phillip Nova. Okay, it likely is going to be populated automatically. You click Next. Okay, so this is when you can connect with an existing trade account. Okay, you put in your login, your password, and your server, which is Phillip Nova demo, very importantly. So after you put in all this information, you can click Finish, and the moment you see that the bottom right corner here is showing green color, that means you are successfully logged into our Phillip Nova server. Okay, so this platform, it may look very daunting in the beginning, but it is a very simple to use, or rather very straightforward platform. It just works like any other Windows applications. So at the top here, you have your menu bar, okay, where it's different things like File, View, Insert, and you also have this group of symbols here. This is what we call a toolbar, where it gives you different tools and functions to draw lines, to draw trend lines, and for you to change your time frames, okay, and also to go into different features. Okay, so let's first look at this Market Watch panel. So this panel right here is where you'll be able to see all the quotes, all the contracts that you can trade, and the bid and the ask spread. Okay, if you want to see everything that the platform has to offer, you can right click and you go to show all. Okay, but otherwise, if there's a specific contract that you want to trade, things like maybe USD, USD, maybe USD CNH or USD JPY. Okay, just click, okay, enter. It will be added into your watch list. Okay, and then to check out the chart for this, you just simply have to drag and drop. There you have it. You have already launched the chart of the dollar yen. To change the time frame on the chart, you can hover up to the toolbox here. You can change to like maybe 4-hourly time frame, 1-hourly time frame. So basically, on a 1-hourly time frame, it means that one candle represents the price movement of 1 hour. 4-hourly means that one candle represents the movement of 4 hour. So generally, we try to encourage people to look at the market trends in terms of the daily first, to gauge the generic uptrend. Okay, then you can look to launch the indicators by going to insert indicators, go to trend, and go to moving average. What I normally do is I'll put 20 and I'll choose exponential. I click OK. So there you have it. I have 120 EMA and I would normally have 2 EMAs on my chart. We have the 50. We have the maybe we put it to blue color. Okay, so you see here I've already managed to put in this indicator. Okay, so what we are seeing now on the dollar yen, actually the dollar has been rebounding over the past couple days, and it is actually rejecting off this 50 EMA line. Okay, and then if we want to launch other indicators, we can also go to like indicators, oscillators, and relative strength index. Okay. Right. Okay, so this is how you launch different indicators for your chart, for your analysis. If you want to delete it, you simply just go to delete indicator window. Right, and what else? Okay, so let's say if you want to draw lines, you want to draw trend lines, okay, then you are able to just draw, just launch this tool here. Okay, draw line. If you want to, maybe from here to here, okay, we managed to draw another trend line. Okay, yeah, so this is just an example. Okay, I'm just looking at whatever a point that I see that I draw a line, but in reality, if you don't see a line, okay, you just don't draw a line. Okay, you don't try to force a line when you don't see any line. Okay, as much as technical analysis can be subjective, we try to keep our rules as objective as we can. But of course, this is a whole new topic, right? Okay, if you want to look at all the contracts that the platform has to offer, you can click on this show symbol list up here. And this is where you can see the full list of contracts that you can trade for this trading challenge. We have the Forex, we have share CFD, okay, we have indices CFD. Okay, so all these contracts you can actually trade during the trading challenge. And then if you want to place a trade, you simply go here, place new order. And let's say if you want to just enter one standard lot, okay, you can just, this is arbitrary by the way, example, you can buy. Okay, once you click buy, okay, your trade would appear in here. USD JPY, you can see that your trade is here in the trade panel. Okay, so like I said earlier, you would always want to set a stop loss level. So how do you set a stop loss level? After you place a trade, very simply, you can hover your mouse, to the line where you execute a trade. Okay, you drag. Okay, so now that you drag, right, you see that this the dotted line appears. If you let go, okay, once again, you need to enable one-click trading for this. Okay, once you've enabled one-click trading for this, the moment you drag in a buy order, the moment you drag below, this will be a stop loss level. And if you drag the line above the entry price, this would be your take profit level. Okay, so you see now I have a SL level, I have the TP level, whereby if prices dips against me, okay, at this point I cut my losses, and I just close the position, I realize my losses automatically, so it doesn't go deeply against me that caused me to lose a lot of money. And if it goes according to my direction, which is to go up, and at this TP level, my take profit would help me, take my profits automatically without having me to monitor the position myself. Okay, and if you want to close the position, you can simply click X here, and you have managed to close your position. Okay, to look at your history, you can come to the history tab to check out your history of your trades. Okay. I see a question. Can you use Phillip MetaTrader for a MacBook? Yes, you do have the MacBook we do have the MacBook version that you can download. The link to download is in the welcome email after you sign up for the trading challenge. Okay. So in the interest of time, I will not have the luxury to share with you every feature here. But MT5, long story short, it has a lot of very useful and advanced features that will help you in your trading. It is in fact the most preferred trading platform that people use to trade forex. Okay, and if you would like to seek deeper help, more help on navigating, you can always go to help. Okay, there are a lot of video guides here whereby you can just take your time to watch these video guides, and they'll be able to tell you how to use the platform and explore different features. Okay, so at this juncture, we'd just like to wrap up the trading challenge once again. So we do look forward to your participation, next Monday. We do wish you all the best, and definitely hope that whatever we shared here today would be able to give you a bit better idea on how to trade. Okay, so of course, for the beginners, this would be a very good learning experience for you to just have a feel of what trading is like. With the prices at stake, you would also be able to experience some of the emotions that traders would feel. So let's say for those of you who are maybe more advanced, more experienced, you can also take this opportunity to prove your skill. Okay, so let's say, you think you are able to make a high profit within 2 weeks. Okay, we wish you luck, and the grand prize that you'll be aiming for this trading challenge would be $2,000. Okay, so at this point, we want to say that from today until tomorrow morning, you still have some time to play around with the trading platform to learn how to trade. You can just place a few trades, but tomorrow, sometime around noon, we will start to restrict the trading access. Okay, we'll freeze all the accounts to reset all your balances to 100K. Okay, so this is to prepare all of us ahead of the trading challenge, so that on Monday 5 a.m. all of us are starting with 100K balance, so that it's fair. Okay, and also we do invite you guys to register for our networking event that will be happening on the 5th of June. Okay, so this is the time where we would get to meet face to face. I get to talk to you, you get to talk to me, we get to interact and to share any questions that we have and to talk about trading. And besides me, and there's also going to be fellow participants, and there's also going to be professional traders present to the event. So it is a really good opportunity for you to network and to make friends and to get inspired by other traders as well. Okay, so do scan this QR code, and also if you're part of the Telegram channel, you can also sign up through the link that is provided in there. Okay, so now let us try to look at some of the questions to address. Okay. Okay, so this trading challenge, it is only open for someone like age between 18 to 30. Okay, so let's say if you're underage, unfortunately, you have to wait until you're 18 to be able to participate and to win a prize, because the prizes will be given out as trading credits in your trading account. So without you being underage, you are not able to open a trading account, as per the rules and regulation. So unfortunately, not able to. Let's see. What other questions do we have? Yes, the slides will be shared to you, or rather, the recording of this session would be shared in the group chat. Okay, in the Telegram channel, and also will be you can stream it on our YouTube channel as well. But the slides wouldn't be shared with you. The recording of this session will be shared. Okay, so then I see another question about time frame. It seems like this is on the time frame analysis. So what time frame that you look at? It depends on your time horizon of your trading strategy. If you're looking at scalping or intraday trading, you can start from 1 day. You narrow down 1 day, the 1 day chart to determine the generic trend. Then you step down to the 4 hourly trend and the 1 hourly trend to look for opportunities where you can enter. But if you're, let's say, looking at the longer term investments, maybe you can look at a weekly chart to determine the trend. And whenever maybe prices it dips down to test the EMA, maybe it's a good chance for you to enter a long trade. Yeah, so things like that. So it really depends on the time horizon that you're trading. So generally, we start from the high time frame, then we narrow down into lower time frames to find actionable levels for us to trade. Okay, so I think there are many other questions, but we will not be able to address them. And I think the main questions I've already addressed. So I think going forward, if you have any questions, you guys can also write into our email. Okay, I think that email to reach out to you is included in your welcome email. It is pftertiary@phillip.com.sg. Okay, you'll be able to reach out to us for any technical assistance, any issues that you're facing. But more importantly, I think we hope to see you on the 5th of June, where we can really meet in person and we can talk about trading. Okay, and I see another question here. Should I also stick to one strategy style rather than fusing and complicating everything? Yes, correct. You should stick to one trading strategy because there are so many different trading strategy out there. Okay, and what I've shared earlier, it is just my strategy that I found for it to be useful. So my strategy consisted of using a few technical indicators. It was only two technical indicators to help me identify the trend, and I look for opportunity to enter based on consolidation pattern. So it is a seeking of confluence between different indicators, okay, and give you a trading call. But different people may have different strategy. Okay, I see another question. Realistically speaking, small accounts capital can't grow as fast compared to huger capital, hence leading to my question of are prop firms the ideal move to grow bigger accounts? Okay, so small accounts capital can't grow as fast compared to huger. Okay, so I get where you're coming from. So trading on a smaller account, i.e., with your own money on a brokerage like Phillip Nova, as compared to trading on a prop firm that gives you a much larger capital for you to begin with. Of course, each will have its pros and cons. For the prop firm accounts, you have to pay a large sum of money, the evaluation fee, and if you blow that account, if you hit the maximum drawdown, you would forfeit your entire maybe a few $100s. Okay, so what I would advise for beginners is you should start by mastering the craft of trading with your own account first, with your own money of maybe a small account. Because I think at the earliest stage of your trading, right, you should not be focusing on making money. The goal at the start of your trading journey should be learning the craft of trading and learning how to protect your capital. Okay, so if you start trading with the intention of making a lot of money, that is when you have already, you put yourself at a disfavor because your expectations are too high. And trading, I'm not gonna sugarcoat it, it's not easy. Okay, majority or rather all of the profitable traders that we know, they take about 1 to 2 years to master uh, the craft of trading and to only be able to be profitable after 1 to 2 years of trading. So my advice is when you're new to trading for the first year, aim to make a return of 0%. I repeat myself, for the first year of trading, aim to make a return of 0%. Because the reality of trading, I believe all of you may have heard of it, that is that majority of FX traders they lose money. Yes, that is true because a lot of them don't have the proper context and understanding of how trading should be done. They don't risk manage. They just go all out, okay, and they lose money. They are scarred by the trading and they just stop doing it. And so these people, they fall under the majority of the statistics that lose money. Okay, so let's say if today you are someone who is serious in mastering the craft of trading, from day one onwards, you know that risk management is the most important skill that you need to manage, and your goal of trading for the first year is to protect your capital, is to not lose money. Okay, so if majority of people lose money trading FX, if at the end of 1 year you consistent trading in and out, and at the end of 1 year you still manage to not lose any money, congratulations. This is where you are better than majority of traders already. Okay, okay. So guys, I really encourage you for the beginning, focus on the craft of trading. Okay, although this trading challenge is all about making a lot of making the highest return within a short span of time, but it's meant for like an opportunity for everyone to learn and get experience and get exposure. But realistically speaking, we should always protect our capital and look at it long term. Okay, we spend 1 to 2 years to master this skill of trading. Okay, and for the longer term, it's gonna reward us with if you're able to consistently be profitable, like maybe every month you are able to make 1 to 2%, 1 to 2% consistently. This is when you can increase your account size, whereby in case of using a small account, you put in more of your own money, a bigger account, and therefore 1 to 2% on a monthly basis could already be a very good amount that you can survive off. Okay, another question. Will the demo account be available after the trading challenge? Yes. After the trading challenge, your trading challenge demo account will be converted into a normal trading account where you can continue using this, for your strategy testing going forward. And I see another question. Above 30 can join the networking session. Yes, of course. We welcome anybody, of different age to come and join, because I think we have, I think the idea is really, beyond the trading competition, is to form this community for you to meet each other, to listen to the professionals, and we could have a chat on the day itself, to exchange ideas on trading and to inspire each other. Okay, so I think with that we have overrun the timing by 20 minutes. Okay, but there are a lot of things that we can talk about in trading, but unfortunately we can talk for days. Literally, we can talk for days, and there are still things for us to talk about, because trading is something I think is very interesting. It's a lot of nuances, a lot of details, and depending on your experience, there are a lot of different experiences that it's just a lot of things. Okay, so 5th of June we meet. We can take the time to talk to each other, and hopefully to level up our trading with this traders community. Okay, so I think with that, thank you very much, ladies and gentlemen. I do wish you all the best in this trading challenge, and we look forward to seeing you on 5th of June. Thank you very much.